Welcome to a fascinating journey into the intricate world of finance and psychology. In this series, we'll dive deep into the psychology of investing, emotions and decision-making to uncover the secrets behind your financial choices. But before we begin, please like and subscribe to our YouTube channel for such amazing and informative videos. 1. Emotional roller coaster. The emotional roller coaster in investing refers to the wild swings in emotions that investors experience as they navigate the financial markets. It's characterized by extreme highs of optimism and confidence during bull markets and deep lows of fear and panic during bear markets. When markets are booming, investors may become overconfident, believing that the good times will never end. They might chase high-flying stocks or assets without conducting proper research, driven by the fear of missing out, FOMO. However, when the market takes a downturn, these same investors can quickly shift to a state of panic, selling their investments in a rush to limit losses. This emotional roller coaster can have detrimental effects on investment performance. Investors who act on emotions often end up buying high near market peaks and selling low in the depths of a market crash. 2. Confirmation bias. Confirmation bias is a cognitive bias that affects decision-making and can be particularly detrimental in the realm of investing. It refers to the tendency of individuals to seek out and interpret information in a way that confirms their pre-existing beliefs or opinions, while ignoring or dismissing information that contradicts those beliefs. In the context of investing, this bias can lead investors to only pay attention to news, research, or opinions that align with their existing views about a particular stock, asset class, or market trend. For instance, if an investor holds a strong belief that a particular technology company is poised for immense growth, they may actively seek out news articles, expert opinions, or research reports that support this belief. Conversely, they might disregard or downplay information that suggests the company may face challenges or overvaluation. 3. Overconfidence. Overconfidence is a cognitive bias where individuals tend to overestimate their abilities, knowledge, or judgment. In the context of investing, overconfidence can lead investors to believe that they have a better understanding of the markets and specific assets than they actually do. This overestimation of their own expertise can lead to excessive trading, higher transaction costs, and ultimately, suboptimal investment outcomes. Overconfident investors might engage in frequent buying and selling, thinking they can time the market or pick winning stocks consistently. However, research has shown that even professional investors struggle to consistently beat the market. Furthermore, overconfidence can lead investors to ignore important information or underestimate risks. 4. Loss aversion. Loss aversion is a psychological bias that describes the tendency of individuals to strongly prefer avoiding losses over acquiring equivalent gains. In other words, people feel the pain of losses more intensely than the pleasure of equivalent gains. This bias is particularly relevant in the world of investing, as it can lead investors to make suboptimal decisions. For example, when faced with the prospect of selling an investment at a loss, many individuals may delay or avoid selling, hoping that the investment will eventually recover. This behavior can result in holding on to underperforming assets for too long, which can lead to further losses. Loss aversion can also lead to a phenomenon known as the sunk cost fallacy. Investors may continue to invest more money in a losing position simply because they have already invested a significant amount and don't want to accept the loss. 5. Herd mentality. Herd mentality, also known as the bandwagon effect or groupthink, is a psychological phenomenon where individuals tend to follow the actions, decisions, or beliefs of a larger group, often without critically evaluating the information or alternatives. In the context of investing, herd mentality can have significant consequences. When investors see others buying or selling a particular asset en masse, they may feel compelled to do the same, driven by the fear of missing out on potential gains or avoiding losses. This behavior can lead to market bubbles and crashes, as asset prices become disconnected from their underlying fundamentals. Herd mentality can also result in a lack of diversification in portfolios, as many investors rush to buy the same popular assets or sectors, thereby increasing risk exposure. To mitigate the negative impact of herd mentality, investors should conduct thorough research, have a well-defined investment strategy, and be willing to go against the crowd when it makes sense based on their analysis. 6. Anchoring. Anchoring is a cognitive bias that describes the tendency of individuals to rely heavily on the first piece of information they encounter when making decisions, even if that information is arbitrary or irrelevant to the decision at hand. In the context of investing, anchoring can manifest in various ways. For example, an investor might anchor their expectations for a stock's future performance based on its historical high price, even if market conditions or the company's fundamentals have changed significantly since then. This can lead to unrealistic expectations and poor decision-making. Another common example of anchoring in investing is when investors fixate on the purchase price of an asset and refuse to sell it for less than that price, even if the asset's current market value is significantly lower. This can result in holding on to underperforming investments for extended periods, in the hope that they will eventually rebound to the anchored price. 7. Regret aversion. Regret aversion is a behavioral bias that describes the tendency of individuals to make choices with the primary goal of avoiding feelings of regret or remorse. In the context of investing, this bias can have significant implications. Investors who are driven by regret aversion may shy away from making decisions that involve any perceived risk, even if those decisions have the potential for significant returns. They might opt for safer but lower-yield investments to minimize the chance of regretting a loss, even if a more diversified or dynamic strategy would be more financially advantageous over the long term. Regret aversion can also lead investors to engage in behavior such as holding onto losing investments for too long, hoping that they will eventually rebound to the initial purchase price. This reluctance to accept losses and make necessary adjustments can hinder portfolio growth and diversification. 8. Diversification benefits. Diversification is a fundamental principle of investment strategy that involves spreading your investments across a variety of asset classes, industries, and geographic regions. The primary benefit of diversification is risk reduction. When you hold a diversified portfolio, the individual performance of any single asset or investment has less impact on your overall portfolio. If one investment underperforms or experiences a downturn, the potential losses can be offset by the positive performance of other holdings. This risk reduction can help protect your portfolio from extreme fluctuations and limit the impact of market volatility. Another significant benefit of diversification is the potential to enhance long-term returns. By holding a mix of assets with different risk and return profiles, you can capture opportunities for growth while still maintaining a level of stability. 9. Goal-based investing. Goal-based investing is an investment approach that centers around achieving specific financial objectives or goals rather than just seeking general market returns. In this strategy, investors identify their individual financial goals, such as saving for retirement, buying a home, funding a child's education, or taking a dream vacation, and then design their investment portfolios around these objectives. Each goal is assigned a targeted time horizon and risk tolerance, which helps determine the appropriate asset allocation and investment strategy. One of the key advantages of goal-based investing is its alignment with investors' real-life objectives. It helps individuals stay focused on their unique financial goals and encourages discipline in their investment decisions. 10. Behavioral finance. Behavioral finance is a field of study that combines principles from psychology and economics to understand and explain how individuals make financial decisions. Unlike traditional finance theories that assume investors always act rationally and in their best financial interest, behavioral finance acknowledges that human behavior is influenced by cognitive biases, emotions, and other psychological factors. These biases can lead to irrational decision-making, which can impact investment choices and market outcomes. One key concept in behavioral finance is the idea that investors often exhibit irrational behavior, such as overreacting to market news, being influenced by social trends, or succumbing to fear and greed. Thank you for joining us on this insightful exploration of the human mind and its impact on investments. Don't forget to like, subscribe, and stay tuned for more intriguing episodes on mastering the art of smart investing.